Welcome to this week's episode of Accredited Investor Markets Radio. Each week, we speak with you about investing in alternative assets. Unbiased and beholden to no one, Accredited Investor Markets Radio does not accept advertising from any investment firm or financial advisor. Accredited Investor Markets Radio is the spoken word sister of AccreditedInvestorMarkets.com, the internet's most comprehensive and unbiased educational resource about crowdfunding, angel investing, venture capital, private equity, private shares, and other investment classes beyond publicly traded stocks and bonds.
Hello, everyone, and welcome to Accredited Investor Markets Radio. I am Christopher Cahill, your host. Later on, I will be speaking with Ted Neild of Gresham Partners. Ted will defend active investing, the honor of active investing, against those who argue that passive investing is really the only strategy to pursue for most investors. Ted will identify areas in which active investing may be decisive in creating greater return. And you can gain access to all of this through the Financial Poise website, www.financialpoise.com. So first, there's an article on AIMkts entitled, "The Next Chapter in Low-Cost Investing, Robo-Investing and Automated Investment Advice." It's written by the AIMkts editors. So the article refers to other articles. There's a wealth of articles on AIMkts.com. And let me just read this very brief blurb. As more and more investors become comfortable with online platforms, many of them are turning away from the traditional personal financial advisor. In a recent article, this newspaper discussed the new startup Robinhood. Separately, MainStreet.com recently ran an interesting piece about how some large investment houses are positioning to compete for Generation X and Y clients. It's worth a read. So we link you to one of our articles about Robinhood and an article by MainStreet.com about similar trends elsewhere in the industry. Well, the robo-investing angle got me thinking about creative destruction, which is how some industries are radically transformed or disappear altogether when human needs are met by means that did not exist at a certain point during those industries' development. There's been a great deal of hue and cry and journalistic ink spilled on the suitability standard versus fiduciary standard dispute. You see, broker-dealers are held to a suitability standard, and investment advisors are held to a, quote, fiduciary standard, end quote, by federal regulations. Well, the Department of Labor has issued a 422-page regulation, which will impose on broker-dealers the suitability standard, which means that broker-dealers who are advising generally less well-heeled persons seeking advice on retirement investment, they're held to a suitability standard, which means that they must offer products that are suitable for those customers, whereas investment advisors are held to a higher standard, the fiduciary standard, which requires them to put the customer's interests above their own. So a broker-dealer might be able to profit indirectly by the products it sells to its customers. Well, okay. The Securities and Exchange Commission is issuing other rules of its own in due course. And there's been a great tussle. The notice and comment period. After a rule is issued, there's a notice and comment period. There have been fights over whether it should be lengthened. My question is, well, what's the harm that's been demonstrated that needs to be addressed by the rule? The journalists haven't discussed that. My next question is, will such harm be redressed by the rule? Well, of course, the journalists haven't discussed that. The critics of the rule argue that raising the broker-dealer standard to the fiduciary standard will cause fewer qualified advisors to be available to serve lower-dollar customers seeking retirement advice. Maybe. I don't know. But maybe robo-investing will make this entire controversy moot. The point is that sometimes it is the unseen that matters most when viewing something in the long term, if you're trying to determine context for investment or context for investment rules. Staying with AIMkts.com. Recently, on May 7, an article was posted entitled, "Tesla is Not a Car Company." The article was written by Jonathan Friedland. It's one of my favorite pieces on AIMkts.com because it illustrates how the unseen is determinative over the long term. The article points out that in 1896 to 1930, there were 1,800 automobile manufacturers in the United States. In 2015, there were more than 250 million cars in the U.S. So, had you been around in 1910, and had you known that there would be 250 million cars in the U.S., and of course, if you had time travel capabilities besides, well, if you emerged in 2015, you'd be richer than Carlos Slim, wouldn't you? The answer, of course, is no, because while the trend toward development may have been spotted, the development of a great and huge automobile market, which company would have survived was unknown then. And all but a handful of those 1,800 automobile manufacturers failed. Friedland provides other examples of similar dynamics. And so when the Tesla founder foresees, quote, a fundamental transformation of how energy is delivered across the earth, end quote, he could be quite correct, and he could be nowhere when it happens. The point is, we see the winners. We forget about the vastly more numerous losers in these transformations. Similarly, we see those who are standing now. We do not see the giants in utero who will topple them. Recall that even IBM seemed untoppleable years ago. Now it's hardly even discussed. Further, we see Apple, which of course famously arose from a garage business, but we do not see the many garage business success stories that never happened, that were blighted in infancy by an unfavorable investment climate in the U.S. or especially elsewhere. That is also unseen. It takes a great deal of imagination to perceive the investment implications of innovation and of government policies that interact with or shape the investment environment. One more round of this. Commercial Bankruptcy Investor is a website that is also a unit of Financial Poise and can be gotten to through www.financialpoise.com. Commercial Bankruptcy Investor provides you with many informative articles about bankruptcy. It's one of 3 bankruptcy websites on the Financial Poise platform. But Commercial Bankruptcy Investor specifically can give you many informative articles on oil and gas. I'll just name a few of them, all written originally by writers for Commercial Bankruptcy Investor. There's a 3-part series entitled Shale and Petroleum, The Big Picture. Another article is Neither a Borrower Nor Lender Be in an Oil Market After a Sharp Plunge in Prices. Also, The Oil and Gas Psychic Hotline. Now, there's a beguiling title. Further, the site will direct you to and discuss other good writings. For example, the site offers recommended reading, Distressed Investor Opportunities in the Oil Patch, Master Recommended Reading, Distressed Investor Opportunities in Oil Patch, Master Limited Partnerships, and also Oil and Gas Restructurings Explained by the Experts, the May 7 Aiken Gump panel event. And there are many, many other articles on the site which discuss specific energy cases. So you can go there and read short, well-written, plain English pieces, not written for specialists, written for you, and learn much to give context to investment decisions and to let your imagination run wild about the unseen. And I'll add to that trove of oil and gas articles one that is not on that site. This is one that I saved. It was written in December, I should say it was published on December 3, 2013. And the article is entitled Robert Bartley's The 7 Fat Years, one of the greatest economics books ever written. And this is a book review by John Tamney of a book that concerned itself with the 1970s economic malaise in the U.S. and the 1980s economic boom. I just want to point out one very brief snippet from it. The author of the article makes a prediction. Remember, this was written in early December 2013. When we return to a strong dollar, and eventually we will, given the desire of Americans for growth, oil and commodity-based economies, think North Dakota in particular, around the world, will face a rude awakening. History always repeats itself, and Bartley would not be fooled by today's energy boom in much the same way that he and the rest of his friends were not fooled back in the 1970s. As he put it, to us, these events were not seen as an oil problem, but a monetary problem. By that he means a strong dollar is what determines oil prices. So how do you measure a dollar? You measure it by how much gold it can buy is one way to measure it. So in December 2013, when this prediction was made, the price per barrel of oil was $99.45. In April 2015, the price per barrel of oil was $59.62. That is a plunge. So crude oil prices did plunge, and it is known that the administration has been pursuing a stronger dollar policy. Now, gold, at the time the article was written in December 2013, was $1,275.86 a troy ounce. In March 2015, it was $1,178.63. So gold became less expensive, which heralds a stronger dollar. Now, single cause explanations are tedious and wrong around the margins, but I was struck by how correct the author of that book review, John Tamny, was about what would happen to oil prices as the dollar strengthened. Of course, it's not talked about much. Maybe a strong dollar is somehow unseen, hiding in plain sight. Now let's get to the interview. Today I have the pleasure of talking with Ted Neild. Ted Neild is President and Chief Investment Officer of Gresham Partners, LLC. As Chief Investment Officer, Ted leads Gresham's investment team as it establishes investment themes, identifies opportunities that fit within the firm's risk-conscious investment approach, and sources investment managers globally. As President, Ted sets and leads the firm's strategic direction and chairs its operating committee. Before joining with Gresham, Ted served as Chief Investment Officer at Nuveen Asset Management, among other senior positions at that firm. Additionally, I should mention that Ted wrote two very good white papers, and I know that they're good white papers because they are now up on the AccreditedInvestorMarkets.com site, as well as at the GreshamPartners.com, all one word, site. And those two papers are, well, they're more or less foundations for what we're going to talk about today. The papers are entitled Challenging the Conventional Wisdom of Portfolio Construction and Challenging the Conventional Wisdom of Manager Selection. So to find them on AccreditedInvestorMarkets.com, just look for Neild, N-E-I-L-D, and Conventional Wisdom. Thank you for being with us today, Ted.
Thank you. Happy to be here.
Well, I'd like to start with what everybody knows. And everybody knows that, you know, you're a babe in the woods if you're a solo investor acting alone. And there's some psychological or basic human tendencies that help account for lesser returns when one is trying to time the market and so forth?
That's actually a really good place to start because I think that human nature is often our worst enemy when we think about investing. We're naturally wired to do the wrong thing at the wrong time, in essence, zig when you should be zagging. For example, I think the easiest way to describe this is when someone has an investment, a stock, let's say, that's really doing well, their natural instinct is to want to pile on, add more, buy more. They like to talk about their winners at cocktail parties and things like that. The exact opposite is what you should be doing. You should be thinking about trimming your winners and rebalancing and moving away from things that are overvalued at that point. The reverse can happen, which is people have a losing investment, and instead of having conviction in the investment and then maybe doubling down at a better valuation, what they tend to do is just cut their losers. And so what people tend to be wired for is a momentum orientation to investing, and it can be very debilitating to the achievement of long-term goals.
Probably from watching too much NCAA basketball and the importance of momentum.
Right.
Well, then many of us have been told, and perhaps it bears repeating, what the benefit of diversification is in connection with what you just said.
Well, I think that's a good related topic. Most people should probably not build a portfolio around a single stock or a small number of stocks. And in fact, most people should think about building a diversified portfolio. And in fact, in all fairness, I think most investors follow that path. They want to build a portfolio. The real question is why. I think people do this sort of out of habit or just sort of a customized behavior. What you're really trying to do when you do that is reduce the volatility of a portfolio. Now, in an intellectual sense, that's actually a good thing to do because a lower volatility portfolio, assuming the same average return, will actually end up with a higher ending net wealth level, meaning if you smooth out the ride, you'll end up in a better place. It's just very difficult to dig out of holes. What's really important about this for individual investors is that there's an emotional component to this. Institutional investors can think about the world in a benchmark relative sense, that if the market's down 30 and they're down 28, institutional investors think about that as a win. Individual investors think about risk differently. They think about risk as the loss of principal. If I lose money, that's a risk. What really compounds that problem is when they start to lose a lot of money, human nature takes over again. And like we talked about before, the instinct is to sell towards the bottom, and it really creates problems. What you're doing is selling at reduced values, and it's really hard to dig out of that hole.
Yes, I have some data here that underscores at least some of what you're saying. That is, just looking at the S&P 500, an index fund, which gained 13.7% in 2014. According to the research I have in front of me, if you missed the 5 best days last year, the gain falls to 3.2%. So if you
It's remarkable, isn't it?
Yes, and if you avoided the 5 worst days last year, your 13.7% gain rises to 26.4%. So there's a timing temptation, and as you say, that's a temptation that ought to be resisted.
It's really hard. Just think about the downside of that is if you, in an attempt to avoid one of those 5 bad days, if you miss one of those 5 good days, you really have dug yourself a deep hole.
So yes, you should diversify. What does that mean? And what are you diversifying? What are the different things that ought to be in a portfolio, conceptually speaking?
I think that's a good place to start. There are 3 primary decisions that an investor makes when they're building a portfolio, and the first one would be what we call strategic allocation, and these are the long-term guideposts. If I were to allocate to a broad array of asset classes and set long-term targets, those would be my strategic allocations. The next decision an investor make would be what we call tactical allocations, which is essentially how do I lean away from those weights, intentionally or unintentionally. Sometimes the portfolio has a way of unbalancing itself because things are appreciating at different rates. So differences from your strategic allocation is what we would call tactical allocation. And the last decision that an investor makes is what we call implementation. For some investors, that's security selection. For some investors, that's what fund to buy, what manager to buy, what mutual fund to buy. And so when you put all 3 of those together, strategic asset allocation, tactical asset allocation, and then implementation, those are the 3 key decisions that an investor makes when building a diversified portfolio.
Okay, well, decisions can be better or worse. So what are some mistakes that investors make in strategic allocation?
Well, there are actually a number that people can make at each level. So start with strategic allocation. I think the one that probably concerns us the most is what we would call building a portfolio that has the illusion of diversification. And what I mean by that is when an investor puts out an array of different asset classes and then fills those buckets per se, they think they have diversified their portfolio because they have invested in a number of different things. In reality, what happens is many of those asset classes are highly correlated in difficult environments. Now think about individual investors again. What really matters for an individual investor is the loss of principal. And so what we really start to think about for individual investors is what happens to those asset classes when the markets are difficult, when the markets are down. And if you think about what people put together, you often see portfolios that have, let's say, large cap stocks and mid cap stocks and small cap stocks and maybe international stocks and even high yield debt. The problem with that is when you look at all of those asset classes, when you get into a difficult environment like 2008, all of those things go down together. And so while you think you've built this diversified portfolio, you actually have a lot more risk in it than you think. And I think most people in 2008, most individuals in 2008, were probably surprised that their portfolio was down as much as it was because they thought they were more diversified than they were. And so that's what we call the illusion of diversification.
So job 1 for an individual should be avoiding disaster when disaster strikes.
Yeah, it should be able to, most importantly, be able to live through those disasters and avoid the temptation of human nature to sell at the bottom.
And just to mention a point that I'm sure we'll touch on later, and you touched on already, institutions do not have the same kind of sensitivity to disaster that individuals have. So it's extra critical for true diversification on the part of individuals when they're doing the strategic allocation. Would that be right?
That's correct.
Good, I'm glad. Now, well, turning to tactical, and this is the more fun stuff because this is where, the individual makes some tactical decisions throughout the year or across the years. What kinds of mistakes can one make there?
Well, this is really where human emotion comes into play again. And the classic example of a portfolio that is starting to move away from the strategic guideposts, those strategic allocation targets, is, let's take last year. U.S. equities were really a great performer last year, as you said, up over 13%. What ends up happening then is that the U.S. equity allocation in a portfolio ends up being overweighted relative to other investments in the portfolio. What an investor should be doing is they should be trimming that and rebalancing back to their targets. What most investors want to do and what they tend to do is they tend to double down. Oh, the U.S. markets have done really well. I should have more of that. And what they're doing is they're investing in things that are naturally higher in valuation and present, quite frankly, more risk to the investor. They should be doing the exact opposite thing. And so those tactical allocation decisions of piling on or trimming the losers when they should be rebalancing back to their targets are the things that get investors in trouble the most.
Okay, and by rebalancing, you mean having the diversification work appropriately. That is,
yes.
You have appropriate amounts of one kind of movement, predictable from one stock in a bad environment, against an appropriate amount of another stock that will behave differently in a bad environment. Is that what you mean by rebalance?
That's exactly correct. And so what happens to the portfolio is it tends to move away from those appropriate amounts or those targets. And so an investor who has a long-term plan should stick to that plan by rebalancing back to those targets, meaning moving the weights of their portfolio back to where they should be in line with their strategic allocation weights.
All right, so then do we have rules of thumb then based upon what you just said for investors to follow?
There probably are a couple of rules of thumb. So, for example, well, let's start by saying that no two investors are the same. So no one's alike here. But there are some rules of thumb. So, for example, for long-term investors, there should be an equity orientation to investment portfolios. And the reason for that is really simple. Equity investments over time should be able to generate the highest return of any of the general asset classes that are out there. And so if you do have a long-term investment horizon and you have a properly constructed portfolio that can withstand the drawdowns of the equity markets, and they can be volatile, those are the investments that should help you achieve your long-term financial goals. So having an equity orientation is important. The other thing is actually that I'd mentioned is what you said before, which is it's really difficult to time the markets. And those 5 days you mentioned before, either to the upside or the downside, a really common mistake is people try to grab those one-day moves and then get back out, or avoid those one-day drawdowns and get back out. And trying to time the market like that is a really difficult thing to do, and investors should just be patient with their portfolio and let it work over time.
Well, plus there are geniuses out there timing the market. Are you really going to beat them?
Well, to be honest with you, I haven't met many of those geniuses. It's just a really hard thing to do.
I should mention in connection with the equity orientation, again, looking at the data I have unearthed, the Standard & Poor's 500 has grown over the last 50 years an average of 9.9% per year. And that would be having an equity orientation, and that is not half bad.
No, if you can achieve close to 10% per year, then you're doing pretty well if you let your portfolio work over a long period of time.
Some say you should not try to time the market. You should use value as a guide. What does that mean, to use value as a guide?
Well, I think this gets back to the tactical allocation element of a portfolio. So when you go through a market cycle, every asset class is going to go through periods where it's overvalued or undervalued, or performs well or performs poorly. Most people, human nature once again, tends to lead us to chase performance. It's doing really well, so I want to add to it. The problem with that, as I mentioned before, is that many of those asset classes, after they have performed well, they end up being overvalued. So today, let's take the U.S. equity market, and we can argue whether it's overvalued or not, but it certainly is at a higher valuation than it was before. So today, U.S. equity market is trading somewhere around 16.5 times forward 4-quarter earnings. When you look at that relative to its historical averages of about 14 times, there's a pretty good sense that the U.S. equity market is overvalued. Now, that doesn't mean it's going to crash tomorrow, but it does mean that over a long period of time, U.S. equity markets are probably going to underperform their historical norms. So if you're thinking about where you should maybe lean away from or lean into, the U.S. equity market might be a way, based on its valuation, or might be a place based on its valuation, to lean away from, slightly underweight rather than overweight it because it's performed well. So that's what I mean by thinking about valuation as a guide to allocation.
Oh, okay. So you're thinking about regressing to means, the tendency to move back to historical averages, perhaps.
Yes.
If you're leaning away from equities, where are you leaning?
Well, that's actually one of the conundrums for investors today. The equity markets have been a great place to be for the last 4 or 5 years. And the problem, as I said, is now valuations are starting to creep up a little bit. That's particularly relevant in the U.S. markets, which have done better than most other markets. And so an investor might want to think about increasing their international allocations. Today, we think emerging markets are actually even more attractive because they've really underperformed for the last couple of years. The real challenge for investors is there's not a lot of places to hide. So fixed income is very overvalued. The 10-year Treasury at 2% or less, which is compounded by very tight credit spreads, fixed income represents a poor value as well. So investors have to be very selective, and if they're not really sure, the best thing to do is just stick to the long-term plan and let the portfolio ride through the cycles rather than trying to time it.
I should mention, again, from my little cheat sheet, that the International Stock Index, EAFE, lost 4.9% in 2014, and some believe that the EAFE index is an unmanaged index that is representative of international stock markets. So there you have, if that's true, there you have perhaps the suggestion that value will return, value will become more robust, and so again, perhaps a reason to lean into that, right?
Yes, I would agree. That's one place to look. It certainly is less highly valued. I mean, in terms of a price-earnings multiple or other measures than the U.S. market. Europe has its challenges, though, and so investors should go into this eyes wide open. That even though it may be cheaper from a valuation perspective, there are also more growth challenges there. As you can see, what the European Central Bank is doing, trying to stimulate the economy. There are more structural frictions there, and so it's probably a riskier place to be, but it could be a better place to be. At the end of the day, though, what we're talking about here is modest changes away from the long-term strategic targets. We're not trying to time these markets by moving 100% out of the U.S. equity markets and into international markets, but based on valuations and relative attractiveness, maybe leaning into them by a couple percentage points one way or the other.
Okay, so enough with the chasing yield. Bring on the leaning. Is avoiding risk a third leg of that tripod, or is that the wrong way to think about risk?
Well, I think risk is really important, and you mentioned our risk-conscious approach at the introduction of your remarks. And one of the things that I think is probably most bothersome to us is that risk is a very misunderstood concept. And really, the industry as a whole is the perpetuator of this problem. And so there are two things that the industry does that really drive us nuts here. One is they look backwards for historical precedent to try to understand the magnitude of risk. So let me spend a minute on this one. If I told you that I drove down an icy mountainous road and I made it through okay, you would say, well, then I told you that it was not a risky thing to do, you would say I was nuts. But I can look backwards and I can say, well, you know what, it was pretty safe. Look what I just came through. And so people go through this backward-looking measure to say, well, the volatility is this or the standard deviation is that, and those are all backward-looking measures. None of those are projections or predictions about what the future holds. And I understand it's easier to do if you can simply look backwards. The second thing that happens is most people try to oversimplify the concept of risk into a single number, standard deviation, volatility, things like that. And risk is complex. There's a mosaic of factors that go into this idea. It's very difficult to explain it. It's very difficult to evaluate it. And so the easiest thing to do is just simplify it to a number. So if I give you a backward-looking single number to measure risk and then try to sell that to an investor, it's just ridiculous to think that in some ways is a good understanding of the risk that you're taking as an investor. And so while we need returns to accomplish our long-term goals, risk is the thing, or more importantly, the misunderstanding of risk is the thing that throws us off our path.
Well, you know, we talked about mistakes that could be made in two of the three areas you identified. We talked about mistakes in strategic allocation. We talked about mistakes in tactical allocation. Maybe you are already talking about mistakes made by managers. But before we get to managers, after all, these are the managers who are looking backwards and telling you what risk means in a particular case, managers who are telling you that risk is one number or another. However, isn't there a school of thought out there that chasing alpha through managerial wizardry, alpha being beating the market, is futile or misguided, so that managers are beside the point, really?
Yes, I think that's a good point. And we didn't talk about possible errors at the implementation level, and so that's a nice segue into this idea. One of the things that we have done as a firm has been able to create a very different portfolio outcome for our clients based on manager selection. And most of the academic literature that you pointed to that's out there that I think is commonly accepted would suggest that it's very difficult to actually try to beat the market. And so there are a couple things that lead you to this. And this is, by the way, this is a subject unto itself, and maybe we'll come back and do have a discussion on this as well. But there are two schools of thought, just very quickly. One is that most of the variability of portfolio outcomes comes from asset allocation decisions. And the second school of thought, or second school of studies, is that if you measure active managers over time, what you'll see is that most of them fail to beat the market.
And so, Ted, I'd like to stop you there, not to interrupt your flow, although I obviously am, but to do a little selling. For Accredited Investor Markets Radio, we have an interview up by Mr. Larry Swedrow of BAM, who I think makes both of those arguments. So it might be useful for our listeners to listen to you and listen to him and become educated thereby. But please continue.
Well, I think the schools of thought and the studies are well researched, and quite frankly, for most investors, this idea of seeking passive investments and lowering the cost of the investment services, the active management, or going completely to passive, I think is actually a pretty good path. The problem is that those studies have been over-extrapolated, and they are very particular studies of a type of investor with certain types of choices. And for more sophisticated investors that have access to different solutions, what we have found is we can actually do better. The frustrating thing is that most investors out there don't have access to a lot of these solutions, whether it's good hedge funds or good private equity investments, or good access to smaller managers in emerging markets or frontier markets where you can really add value because those markets are very, very inefficient. And so what I would say is I would agree with the earlier discussion you had that for many investors, passive low-cost investment solutions are a pretty good thing to do, particularly in highly efficient markets like U.S. markets, U.S. equity markets in the large cap space or fixed income markets. But when you get to less efficient markets and you can have access to great managers that are not the big asset gatherers, you can actually make a significant difference. And so the answer is not yes or no to active versus passive. It is actually, it depends on the circumstances in the market.
Well, very briefly, what you say in your white papers regarding what academic research has measured and how it's not necessarily applicable to individual investors reminds me of a metaphor that's used often in the social sciences. I used to be a social scientist, which is the drunkard looking for his keys. You know this metaphor?
Oh, yeah, it's great.
So it's the drunkard looking for his...
Not that I'm personally familiar with this, but...
Right, no, of course. The drunkard looks for his keys, and the policeman comes upon him and says, what are you doing? He says, I'm looking for my keys. You know, he's looking under a lit lamppost in the middle of a dark parking lot. And the policeman says, well, where'd you lose them? Well, somewhere out there, pointing into the darkness. And the policeman asks him, well, why are you looking under this lamppost? And the drunkard says, because the light is better here.
Right. You know, and to be honest with you, that's in some ways the investment universe. And so many of the individual investors that are out there that have access to the common open architecture platforms or the mutual funds, that's like looking for your keys under the light. That's all that most people have access to, and that's all the only place they can search. When you move away from that area and you have a much broader range of active strategies to choose from, there's a much better chance you can find your keys. There's a much better chance you can achieve your objectives.
Well, in the NFL as well as in podcasts, takeaways are all important. So what takeaways would you give our investor listeners as we close?
Well, two things. One, I go back to our discussion about human nature. This is a really hard thing to do, and quite frankly, even investment professionals, people who are in this business like our team here that have done this for decades, it's very hard sometimes to fight human nature. So you really have to have a well-defined plan and stick to it through very difficult periods of time. It will be the thing that gets you through difficult periods. So understanding what your strategic allocation should be, making sure you're rebalancing to it, making sure you're not succumbing to the human tendencies of selling when things are down and chasing performance. That's the first thing. I think that's really important. The second thing I would tell you is that if you don't have access to some of these better investment solutions, I think trying to minimize cost is actually a pretty good idea. But if you do have access to some of these solutions, there can actually be a very different investment result than what most of the common academic literature would suggest.
Well, let's leave it there. Ted, this has been most substantive, and Ted Neild, I thank you for participating on this program.
My pleasure.
This has been Accredited Investor Markets Radio. I am your host, Christopher Cahill. Accredited Investor Markets Radio is produced by Stephanie Strait. Let's do this again sometime.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.AIMkts.com. Each week, Accredited Investor Markets Radio brings you news and education about investing with a focus on alternative assets. To see a short written summary of this episode, go to www.AIMkts.com. Accredited Investor Markets Radio is a production of Financial Poise Radio Productions, LLC.